It looks like we have somebody else, but I cannot see who this might be. Oh, Dominic, how you doing?
Good, how are you?
Good to see you. I guess we'll wait a minute or two, okay? So you joins us.
Yeah, sounds good.
Hey, the Jets almost won a game last night, but it wasn't to be.
Oh yeah, I'm a Chargers fan, but right now I'm in on baseball and basketball because I like the Lakers and Dodgers.
The Lakers are really in the catbird seat. Miami's got two guys hurt, right?
Yeah, so game two is today, but it's not looking good yet for the Heat. But I was actually really sad that they got hurt. I wanted it to be more of a fair series, but we'll see how it goes.
Yeah, I'm a lifetime Boston Celtic fan, so that was a killer
Oh
win.
yeah.
Yeah, I thought they'd have a better series than they did against the Heat, but
hmm
what are you
Yeah,
gonna
I
do?
really wanted to see Lakers Celtics finals. I don't really remember 2010 that much, so it would have been fun to see it this year.
If you ever want to Google some ancient history, Google Game 7 of the 1962 NBA playoffs,
Oh
where
yeah,
where Frank
Bill
Selby,
Russell.
yeah, the Russell era, where the game was tied in the last seconds, and Frank Selby, the Lakers, missed a pretty easy jump shot from about 15 feet in the corner. He was just a great shooter. And then the Celtics, of course, went on to win in overtime. Or
Oh
Google
wow.
the Game 7, 1969, when the Lakers were huge favorites with Wilt Chamberlain and Jerry West and Elgin Baylor, but it wasn't to be. Celtics upset them.
Wow.
Anyway, let's see, what time we got here? Anyway, can't even tell.
It's 10 on the dot.
Okay. All right. Okay, you and I can get started, and others will join us. Dominic, you have any questions or anything you want me to talk about at this point? Have you taken a shot at the homework?
Yeah, so right now all I have left is the chapter 3 quiz and the exercises. So I started on the exercises. Oh,
Okay.
and the extra credit problem. But
Uh,
actually, I don't know. So the extra credit, I was looking at it, it looks, I don't know, it looks a little confusing. Do you think you could touch on it?
the extra credit crop problem. I'm going to have to take a look at that. I'm not even sure what that
All
is, to be
right.
honest with you. That was a
Okay.
Cornelia creation, and I'll be glad to do that. I'll
Yeah.
take a peek. And so, what you're saying is it was a little vague in terms of what you're supposed to do.
Well, yeah, the instructions are laid are just laid out in a way I couldn't really
Okay.
cultivate.
Okay. All
So
right.
okay, well, I guess it's more simple the second time looking at it. It's just recording a journal entry for each. I guess it's like what we've done before. It's just
Okay.
recording a journal entry for each letter. But I guess the
Okay.
first time looking at it, the format threw me off.
All right. Do you want to share the screen and show me what you're talking about? Are you able to do that?
Yeah, I can pull. I was pulling it up on my phone, but I can pull it up on my computer. Let me do that real quick.
Yeah. Gee, I hope we have some company coming, huh?
Um, think let's see. Trying to find the instructions.
Get my notes going here.
Oh, here we go. Okay. Share screen. Oh, it says the host disabled screen sharing. I don't know
Oh,
if you have that.
I have to give it to you, I think. Hold on.
I think so. I can try to request it.
Yeah, maybe show your face if you don't mind.
Yeah, sure.
Unless
I'm
you're.
just Yeah, there's the cleaning lady here, so I'm just moving around, but sure.
I thought you might have been in a compromising position there. Hold on. All right. The second you, sir, will become the host. Are you ready?
Okay. Okay. Let me.
Yeah. Now whatever you put on the screen, I should see.
Okay. So I think this. Do you? I can't. I don't. Oh, I have to press share. Okay. Do you
Okay.
see that?
Oh, yeah. Okay, yeah. Oh, God, this problem's been going on for a long time. In different versions. Okay. All
And then
right.
she also gave us like an Excel something for it, but I was just like, I don't know.
Okay. Are you okay? Do you want to go over this problem then a little bit?
Yeah, that's okay. I think this is the extra credit one. I think.
Okay. Let me just say, what are they asking? The following.
Oops.
Okay. For each, go to the bottom where the required is. Let me look at
Okay.
that. Journal entries. Journal entries. Journal entries. Okay. All right. Well, you know what a journal entry is now, right?
Yeah.
And we know what a debit and a credit is. So let's go back up there. We
So
can.
yeah. So the Excel template.
You have to. Okay.
Oh. Oh,
You
here
know
we go. Here it is here. Okay. So I guess it is. I don't know. Maybe I just thought there was more to it, but let's see.
looks like they just want you to write those 7 or 8, whatever it is, dozen journal entries.
Just in a journal entry. Okay.
Yeah.
All right.
Yes.
I guess it's just easier than I thought. I just wanted to make sure I didn't miss anything.
Okay. Unless there's a requirement 2. I see a 1 there. That might tell me there's a 2.
Yeah. No, there's nothing below here.
Hold on 1 second, because I think that this problem's in the book here. Hold on. That's in chapter 3, huh?
I
Chapter
think
3.
so. It says P3-7
P3
and
is,
learning objective 3-4. So yeah, I assume it's in 3.
yeah, Cedar. Cedar Point, Ohio. That's where I used to live, right next to that place. Anyway,
All right.
yeah, I have it right here. Required for each of these transactions, use journal entries. 2. Now she may not have given you this part of it. I don't know. 2, you're supposed to indicate what the cash flow is: operating, investing, or financing. Remember, we talked a little bit about cash flows and
Yeah.
how we're not going to do much with them until we get into the chapter on the cash flows. But I did say you have 3 kinds of cash flows we need to understand: operating, investing, and financing. And then they want to know the effect up or down. Jesus. Okay. All right. I would just, right now, let's just worry about the journal entries. You think you're comfortable trying to put those together?
Oh yeah.
Okay. So once you have the journal entries together, they're giving me,
Oh, you cut out a bit.
yeah, they're giving
Oh
me. Do you see the other part of the problem, or is there another part of there?
no, there isn't. It's
Okay.
only number 1.
Okay. So don't forget everything after number 1. Then I think Cornelia wisely trimmed this problem for that reason. Okay.
Okay.
All right.
Cool.
So
Thank you.
you can take a shot at that. What else you got? You want me to go over the PowerPoints a little more, or any problems with the homework or the assignments?
I'm so far good on that. Like I said, all I have to do left is the quiz, and the exercises been pretty fine. It was basically that extra credit that it kind of tripped me up a little, but
Okay, that was the extra credit problem, huh?
yeah, that was the extra
Okay.
credit problem.
Okay, sounds good. Hi, Nicole. Welcome. And there's Dominic. And Nicole is muted. You are muted right now.
Okay, there you go.
There we go. Now we can talk. Dominic was just going over the extra credit problem. Could you put that back up on the screen, Dominic?
Yeah.
He's the host right now for just a moment. And then I got to kick him out as host. Oh, that's just a template to fill it in, huh?
So this is the Excel, yeah. So, but then the instructions.
Oh, that's the
here.
one. That's the part I was just talking about there.
Okay, yeah, I wasn't sure which one. So yeah, these are the instructions.
Yeah. On this problem, Nicole, it's extra credit. I don't know if you've gotten to this yet. It's problem P37. It asks for journal entries for this amusement park corporation, and then once the journal entries are prepared, they want you to fill out this grid here. They want you to know what happened to cash? And that's all we're talking about in this little grid here. Cash. What happened to cash? Did it go up or down? So that part shouldn't be too tough, huh? Up and down.
Okay.
What
That
they
was
want
on
to
a
know,
quiz yesterday.
yeah, and what they want to know here is what kind of flow it was: operating, financing, or investing. Okay.
Okay.
And I guess you could turn the screen back to me if you would.
Okay.
Okay. Yeah. So what they're saying is we've got three kinds of flows, right?
Mhm.
Cash flows: operating, investing, financing. Who wants to take this one for a toss-up question for $5? Financing. What is financing cash flows? Where do they come from?
Like shareholders.
Yeah. Issuing stock to the public, absolutely. And what's another way?
Debt, like debt, like
Exactly.
creditors.
Yes,
Mhm.
Dominic's right on there, huh, Nicole? Yeah.
Yeah.
Financing is borrowing money or raising money through a stock issue, bond issue, or whatever. Okay. What's investing? What are the key parts of investing?
To it has to do with like to increase the productivity, right?
Yeah, you could say it that way.
Or kind of.
You're on the right track there. Yeah, investing will be the purchase of a large fixed asset. That's investing. That's one component of investing. Again, I go to my favorite company, Coca-Cola. They go out and they buy $1 million machine that pumps out bottles of soda in milliseconds. That machine is going to last for a long time. That's called an investing cash flow. Obviously, it's a cash outflow. Okay. And then, of course, the other type of investing is a company has money lying around that they're able to invest perhaps in the stock of another company. Like I said, Bill Gates from Microsoft, he might want to buy General Electric stock, his company. If they do that, that would be an investing cash outflow. Any monies that come in from those investments in terms of the stock or whatever, that would be an inflow, obviously. Make a little bit of sense? And then what's operating? And don't say everything else.
Everyday activities. Like everyday
Exactly.
transactions.
Every transaction that is a result of trying to make soda, in our example. Yeah. What are the normal expenses Coca-Cola incurs in preparing its sodas? It pays its people. It pays its people, pays its rent. It buys raw materials. It sells things, etc. Okay. All right. Is there anything particularly you want to look at, Nicole? Otherwise, I thought I'd go back to the PowerPoints.
As of right now, I think I'm okay.
Okay.
Yeah, I don't think I have anything in particular.
All right. Hold on here. Hold on here. Come on. Where did everybody go? Here we are. Full screen. I am a whiz with this stuff, huh? Share screen. It says host disabled screen sharing. Hold on.
Am I still the host?
Are you still the host? Did you make, hold
I
up.
don't know. Whoops.
Yeah,
I might
can you go into, I think you go into participants and then click on my name and say, make me the host. I think I can probably
Yeah,
just step.
wait. Oh, okay. I could click on your name and make you the host.
Yeah.
I don't know how to. Oh, yeah, make host. There we go.
Hey,
there we
I
go.
am the host with the most. Okay, here we go. Can we see the PowerPoints?
Yes.
Okay. I'm not going to take us through it in all the detail we did the other day. Plus, this is a different set of PowerPoints. And I noticed it had a couple of little twist to it. Hold on one moment here. Now I have my napkins and tissues. Okay. Investing. This looks a little different, huh? What activities cause changes in the balance sheet? How do these specific accounts affect each other? How do we keep track of things? How do we do it, ladies and gentlemen? Boy, I don't know if we really want to look at this too much. The conceptual framework, what's the objective of preparing these things for external users? Obviously, provide financial information about the reporting entity that's useful to existing and potential investors, leaders. I think we kind of understand that. The financial statements, they got to be relevant and material. You don't want them buried with tiny little nits that are perhaps distracting, like maybe set up a separate account for pencils or something like that. The relevance talks about being a faithful representation of what the company is trying to do. And the attributes, they should be comparable from year to year. That's real important. Comparable from year to year. Companies can't change, for example, their depreciation methods by just snapping their fingers. They got to be verifiable, which is what the auditors do. And they have to be timely. And guess what? They have to be readable, understandable. Timeliness. It doesn't do an investor any good if you found out that your company is practically bankrupt at the end of 2019, but you didn't get the word out until the end of the following year. Timeliness. Now we're going to measure assets, liabilities, the accounting equation, and the revenues, expenses. Remember these two things we talked about a little bit. The recognition assumption. We assume that the business is a separate entity. That might be the first time I'm using those terms. Separate entity. It means that we believe the business is a standalone operation that is going to continue, not be on the verge of bankrupt, and they're using using money to be measured over a time period. The key thing here is separate entity is an accounting term, meaning that a business is by itself an organization that can be organized, and we assume it's a going concern, and we assume they're using a stable monetary unit. And that might sound silly, but my goodness, if you live in Venezuela, for example, over the last decade or so, it's dreadful what's happened down there, and the inflation that's roaring there. Okay, and then we talked about the matching principle quite a lot. When was it? Monday, huh? And this is just another look at what you already know, huh? Assets, anything of value. The only reason I'm showing you these Rube Goldberg type descriptions is these are the types of things the system likes to throw out as a multiple choice. An asset, an economic resource with probable future benefits owned by the company, measured by the historical cost principle. Everything on your balance sheet is at the cost at the time of the purchase and can never be written up to a higher level. Not until we get to a chapter toward the end of the class, there's an exception. Liabilities. Liabilities, we know what those are. Debts. And the balance of these two numbers, assets minus liabilities, is what the business is worth on paper. Your net worth, stockholders' equity, you call it capital, stockholders' capital. And yesterday, we on the other slide, they showed us like 3 or 4 different versions of the same thing. Here they're showing you what's called a consolidated balance sheet, consolidated. What it means is Chipotle's. Now we're talking Chipotle. We were Papa John's the other day. I like Chipotle's. Chipotle's has different businesses all over the country. They have different stores. They have stores in Mexico, in the United States, all over the world. This consolidated balance sheet is telling the world This includes everything in the Chipotle world. They could have a consolidated balance sheet just perhaps for the United States, but means all the subsidiaries are combined, huh? And this is a really good, I think, quick explanation of some of the line items, okay? We know what cash is. Short-term investments. You went out and you bought another company's stock, invested in the company, or you loan that company money in the hopes of earning some interest for a while. Accounts receivable, payments due from customers. Forget the others. From customers, no others. Notes receivable would be if we loaned money to somebody, and what they owe us would be called the notes receivable or interest receivable. Supplies, I wish it said prepaid in front of it because that was really the right words. It's prepaid supplies, prepaid expenses. These are things we pay in advance but have not used them yet. This is your prepaid expense world, and it's the reciprocal of the unearned revenue. Reciprocal of the unearned revenue. Prepaid insurance. I sold Nicole insurance today. You paid me. You credited cash, and you debited this asset called the prepaid expense, prepaid insurance. You don't have any expense yet until when? Until the insurance policy pops in, right?
Yeah.
You bought this policy December 31st. It was your tough luck. The plant burned down 2 hours later. You don't have insurance. You were supposed to torch the place. He was supposed to torch the place the next day. Anyway, I probably should take that out of this presentation. But you get the idea. So you debited that asset you purchased from me and credited cash. I, in turn, of course, debited cash, but I credited unearned revenue because I have not provided any insurance to you yet. Unearned revenue. That is a liability account, and it is a liability in the sense that you don't owe me cash, you owe me the service. In this case, it's insurance coverage, okay? They're using unredeemed gift cards. I think that's a good example, right? That's a great example. You know, you go to Costco and maybe your uncle gave you $100 gift certificate. You bought a gift certificate from them. That is not income to them until you show up at the store. I'm going to digress just a little bit. Cornelia and I will probably give out, I'll say Cornelia will, she's in charge of the actual assignments this semester, I am not. But there's usually a real good article that we give to this class on the accounting for gift cards and how companies now have to kind of estimate what might happen with them, okay? Prepaid expenses, here we go, investments, property and equipment. Any current asset is either going to be, is likely to be in the nature of an investment. Property and equipment, land, the accumulated depreciation. And you notice you have short-term investments, long-term. Long-term means it's something that you're going to be holding for over a year. It doesn't come due in a year. Under a year would be current, right? And let's just go quickly down here. Accounts payable, payments due to suppliers. I'm glad it doesn't say and others, which it does up here. That and others needs to go. And these are your accrued expenses. Accrued. Here, the accrued expenses are those we've experienced, we've incurred, they have happened, we've gotten the benefit of them, but we don't have the bill yet. We haven't paid it. We may even have to estimate some of this stuff. The utilities is a terrific example. We know we used water during the period. We're not going to wait 30 days for the water company bill to arrive. We're going to have to estimate something with an accrual. An accrual is a temporary payable, okay? Notes payable. The difference between notes payable, accounts payable is pretty easy to understand, but I do want to pop into it a little more. Notes payable, written obligations due beyond the next 12 months. That is not, that is correct if it's a long-term note payable. The reason I hesitated, you see current liabilities here?
Mhm.
By putting the note payable after the current liabilities, that makes this statement correct. Written obligations due beyond the next 12 months, okay? You purchased, you sold me a bond, a 30-year bond, okay? That's a long term. If you saw notes payable in the current liability, it would obviously be for less than a year. And a lot of notes are 1 month, 2 months. With the interest rates so super low as they are now, I'm guessing a lot of people are buying short-term notes in the hope that the interest rates go up so they can, get a little more return. And what did we say about the common stock last night, Nicole? How do we figure this $300?
You multiply the shares, the amount of shares by the par value.
Exactly. On this line here, Dominic and everybody, the common stock line is always the par value multiplied by the shares. It's always the par value multiplied by the shares. It has nothing to do with what the stock is really worth. This common stock here for 1 cent, when it was issued to the public, look how much the public paid on top of that. Now, this is a super exaggerated look, but look at this. The par value was only a penny, but they issued this stock for $372,700. The additional paid-in capital is the excess amount received over the par value. When Zuckerberg wanted to cash in, he's the Facebook guy, right? On Facebook. He finally took the company public about 8 years ago. I think it was $1 par value, and he expected to get $50 a share from the public, and he didn't quite get that. He got 30, and he only made a few billion instead of many billions. But the stock has bounced back since then. Okay. Retained earnings. This is the one students have a little trouble understanding at first. Retained earnings. Part of equity. It represents the earnings of Chipotle's since day one. Chipotle's, we're going to pretend now, never paid a dividend. Since the company was organized, their net profits and losses have accumulated to $671,500. Retained earnings, you're retaining the profit. And we talk a little bit about external and internal. Is that anybody? One of you guys has a little noise in the background. It's a little distracting if you're listening to a.
Oh, that might be my mom talking.
Okay. We don't want to give the mom a hard time. That's okay. Mother knows best. Okay. External events. These are the ones, of course, with outside parties. We borrowed money. We paid somebody, right? We paid the phone bill, blah, blah, blah. External. The next chapter, when we get into adjusting entries, those are the internals. These are the adjusting journal entries. Have you tried to do any of the homework with adjusting journal entries yet, Nicole? From your reaction,
we did for chapter 2.
Okay.
Yeah.
That's the next. Okay. Here's your general ledger. The general ledger, the books of the company. You're going to have a pile of folders, fancy T accounts, one for cash, one for equipment, one for whatever the company needs to track very clearly. You'd have one for stationery, perhaps, but you wouldn't have one for pencils. You wouldn't have one for erasers, although you could. And that was what we were talking about a little bit earlier, how you can muddy the water by doing that kind of pedantic reporting. Account titles. I'm glad they put this up here. Typical account titles, huh? Well, we should know this. I'll start on the left side. Accounts with receivables are always assets from customers. Prepaid expenses, oddly enough, is an asset. An asset. That's an asset that we're going to debit upon buying that prepaid asset and credit as we use it. And the debit will be to whatever the expense is. I have students who get stuck at the beginning because they're, a little nervous or they're not thinking. They'll say, hey, Bob, they used $500 prepaid insurance. I know I credit prepaid insurance. What do I debit? Don't think. Insurance expense, of course, is what you're trying to do. Typical account titles, payables, unearned. Unearned means money's paid in advance to us. Unearned revenue is the same as prepaid expenses. Prepaid expenses, unearned revenue, same thing. The difference is here, you bought an insurance policy, debited prepaid expenses, credited cash. Here, I received your payment, thank you. I debited cash and credited unearned revenue until the new year begins, huh? Revenues, sales revenues, fees, expenses, we should know expenses. Hey, Dominic, are you there?
Yeah. Oh, yeah.
All right, I'm gonna ask you a tough one. Tell me what cost
All
of
right.
goods sold is.
Like where it falls under here?
Well, there it is. It's an expense. What is cost of goods sold? What is that expense?
Oh, sorry. Like what type of expense is it? Like a debit or a credit or?
No, it's an expense with a normal debit balance. My question is, what does that number represent? And I don't mean to bust your chops because this is always a little tricky. Cost of goods sold is simply the amount we paid for the item we just sold.
Mm-hmm.
We sold a garment for $1,000 to a customer, okay? So that would be our debit to cash and a credit to sales, right? What we paid $400 for that garment, that's the cost of that garment. And at that point, we have to debit the expense called cost of goods sold and credit the inventory. So cost of goods sold is a tricky one. And we will keep pounding that one in.
Yeah, that's like marketing and stuff also, right?
No. Don't make that mistake. That's the road a lot of you guys want to go down. It's simply what you paid for the goods. That's all. It's simply what you paid the sewing company or the clothier. Okay. You go out and you Coca-Cola. The cost of this bottle of whiskey here is the cost of the plastic, the tape, whatever's in there. Cost of goods sold. What did we pay for this item? That's all. Everything else is called an operating expense, and we'll get to that. I think we know our accounting equation, which must always be in balance, must always have one debit and one credit minimum. Then they're taking you through their thought process. And I think we've gone through this a little bit. Everybody kind of thinks their way through a little differently, I suppose. Okay, here we go. This is a new transaction we didn't have in Monday's class. Apparently, I was supposed to use this set of slides, but they're both pretty much the same. Chipotle issued 10,000 shares of stock, huh? 10,000 more shares. A penny a share is the par value. They received 62,300. So we're going to have to debit cash for 62.3. What would be the par value? Anybody want to do the arithmetic? How many shares? 10,000 shares.
Yes. So
what was the par value?
100.
A penny. Yeah. 10,000 times 0.01. Don't make it any harder. We're good with that, right, guys?
Mm-hmm.
The stock shares times the par value will always be the common stock line. Any difference between that and the cash you receive goes to the account that we want to call additional paid-in capital. Some people call it paid-in capital in excess of par. Okay. Why did the public pay so much more than 1 penny? The answer is the penny is a meaningless number. Par value is a meaningless nominal number required by many states, probably by almost all states in almost all circumstances. You can have no par stock. They borrowed $2,000 from the bank to be paid in 3 years. Is that a short-term note or a long-term note?
Long-term.
Long-term, yeah, it's more than a year. So what they're doing here, and I'm going to go through this fairly quickly because the guts is going to be when we zip back into the next chapter. Here they're just laying out the accounting equation for you. They're showing you with the first transaction, we got the money on the stock issue and we put it in equity in the form of the par value and the excess here. We borrowed money, that goes up, so does the notes payable. They bought ovens and things costing $61,000 and paid some of it in cash. Let's take a look at it. They purchased ovens, counters, refrigerators, and other equipment costing $63,100. Well, we now have an asset that cost us $63,100. We paid cash $55,100, and we owe the balance right here. And they're telling you it was a note. Otherwise, it would be accounts payable. And notice that the equation remains in balance at all times. What happened here? We lost this one. Okay. Remember we borrowed money? They now paid $400 toward it. And we don't have to worry about the interest. Isn't that nice? We debit cash. I don't want to say, what did I just say? Did I say just debit cash? We credit cash. Credit cash. We reduce cash in this chapter, huh? And we also reduce the notes payable. And our equation remains in balance. Purchase stock. They intend to hold 20 of it as long-term and the rest is short-term. Oh, here we go. Here we go. They purchased the stock of other companies, paid that much in cash, and short-term investment, long-term investment. They didn't issue stock, right? Don't get confused. We went out and we bought stock. Chipotle's went out and bought a ton of McDonald's stock or something. So they have an investment in the form of a short-term amount and a long-term amount. And we're just accumulating all these totals. They don't pay dividends. Ooh. Well, that might not be a bad thing. I have friends of mine who don't want to get dividends from some of the companies they own. And the reason is they want the company to do what Chipotle's doing, reinvest in growing the business. The price of the stock today is $100. I don't want a darn dollar in the mail. I'd rather you keep that buck and grow the business so the stock triples and I can really make some money. So they reinvest. They declared they'll pay $300,000 cash in dividends. I thought they just said they don't do dividends, huh? But okay, here we go. So they will pay $3,000 in cash as dividends. Okay, so the liability account goes up. I'll be glad when we get to the next chapter in a few minutes. We can start saying debits and credits again. The payable goes up, but what happened to equity? Did it go up or down?
No.
It went down. And Dominic, this is something that we're really seeing for the first time. Keep in mind, any dividend of any kind, a cash dividend or a stock dividend, will always require a debit or reduction to retained earnings. That's because when a company issues a dividend, they are giving away ownership of the company to somebody else, okay? They have reduced the value of that business by giving you this dividend. The accounting cycle. Okay, let's take a peek at this. This is a little better presentation than I think on Monday. The accounting cycle. during the period, chapters 2 and 3. You analyze things all month, huh? You figure out what the payroll is and you record, you pay bills, you buy things, you record invoices, all kinds of things. You write journal entries and you're posting all the time to the general ledger. At the end of the month, you snap your fingers a certain point in time and prepare a trial balance. The trial balance is the rendering of the chart of accounts in order by assets, liabilities, equity, revenues, and expenses. And in the case of assets, they have a separate category beginning with the current assets and current liabilities. Then we have to do some adjusting entries. We have to do them. Can't avoid them. These are going to be our internal entries. And then once we're happy that we've adjusted the trial balance correctly, we can use it to prepare the financial statements and the closing entries. Okay, now we're talking our language, right? Our language. I know Dominic is real good with the debits and credits. I think you are now, Nicole. I'm going to pretty much assume that from what I see, huh? Right?
Yeah, I have my note that I always go back to, but I'll get it.
Right. Well, like I said, after eating dinner, let's read comics. That's one way. Anyway, that's just one mnemonic of many. Okay, assets that we know what the debits and credits are. Our stockholders' equity. Oh, pardon me. Our stockholders' equity right now consists of contributed capital and earned capital, meaning retained earnings. I've never heard that expression, really, earned capital. Retained earnings. So you have 3 lines now. When you do your equity statement, you're going to have line 1, common stock. To its right would be the additional paid-in capital, and then the retained earnings. Assets equals liabilities plus equity. The journal entry. Let's look at this real briefly. I know we should be beyond this now. Others who haven't been coming into the lessons here might appreciate this a little bit. The journal entry, that is the mechanism that updates your general ledger. You are going to sit down at your computer screen, whether you're in QuickBooks or Oracle or some other huge software, and you're going to prepare journal entries. And the journal entry will have a date. It says A, but we'll talk dates as we go along in the course. And you're going to put down first the debits, if you can. Not a hard and fast rule, but you like to have the debits first if you can. Not a hard and fast rule. What is a hard and fast rule is the need to indent. That is the convention. That's what auditors expect to see. It's done to make the reading of the journal entries a little clearer. And over here, you have the debit side and the credit side, and they must equal. Who knew, huh? So there is your first journal entry. And then after you write the journal entries, you look them over. And before you hit the post button, which will permanently put it on your general ledger, you look at it, you're happy with it, whammo, you hit post, and all of a sudden, your general ledger will show the 62.3 and the 100 and the balance in paid-in capital, okay? Your T account is a poor man's general ledger. The general ledger is really a fancy pair of T accounts. One for the transaction, one for the balance. Okay, excuse me. Okay. Beginning balance of cash plus that entry gives you an ending balance, huh? Transaction. So now they're going to show these same transactions in journal entry form. Issued 10,000 shares at a penny. Well, we know the par value is $100 then.
Mm-hmm.
And here it is. Now, I know we know how to do the journal entry. Let's keep our focus here on the equation remaining in balance and what happened when you posted it. Here's your general ledger now, right down here. They borrowed $2,000. cash debit, credit that payable, notes payable. It's a long-term note. They're not delineating that, but okay. Cash went up 2,000, and now the note went up. So we're taking on some more debt. Now do the remaining transactions yourself. I wasn't expecting that slide, okay? But take a look at it. Take a look at the result of preparing all of those journal entries. You prepared all those journal entries, but you never posted anything until the end of the month. And at that point, you went in there and said, everything looks good, I post. So look at your T accounts here. Look at your general ledger. Cash now has a balance of $349,600. How do we figure out the balance? Well, I think we know that it's 401,000 plus this, minus the credit side. Easier way to say it is you add the two columns up, and the high man wins. Excuse me, guys.
I have a quick question.
Yes.
Okay, so let's say we sold Coke for $400, right, in total. And
Say that again, please. Start again, please. You sold what?
Let's say we made like a Coke or a bunch of cans
go
of Coke for $400, and then the cost of goods sold were $200. Wouldn't that make it unbalanced? Where do we put the extra $200?
No, because it's a 4-line journal entry.
Okay.
You sold it for cash, right? You debit cash and you credit sales. If you're good with me on that one?
Oh, yeah, got it.
Now we have the cost of goods sold to deal with. $200 debit, and what do we credit? Guess what? It came out of our inventory.
Okay.
You debit cost of goods sold, and you credit
inventory.
Yes, you want that to be out of balance in terms of the sales were more than the cost. So we made a profit of $200 on that.
Okay.
Good question. Okay, so now we're looking at this general ledger, and we see all of our balances, and we're pretty sure it balances. Debits equal credits. So what did we do? We then went into our system and said, print a trial balance. And there is the Chipotle trial balance. And where are they getting these numbers? Where did they get that 349,600? Where did they get that 94.5 and the 8,400? Right from the ending balances in your general ledger. Okay? Right from those ending balances. So here we go. The trial balance listed in the proper order, and all it does is tell us that debits equal credits, and it provides us with a tool to prepare the month-end financial statements, okay? Prepare the month-end financial statements. Classified balance sheet, just a fancy word for we're going to break out the current and non-current assets and liabilities. Current assets, those to be turned into cash within the upcoming year. Current liabilities, the stuff we're going to pay in the next 12 months, okay? A year is a sufficient explanation. And depending on the business, it could be the cycle. You know, if you're a farmer, you might have a 9-month cycle from planting to harvest. Now, this is interesting. Here is the balance sheet. Remember, we had that 349.6? That was the balance sheet at the end of March 2012. Now they're showing you the balance sheet prior quarter, the ending of the 31st. And this is what you're going to see in every stockholders packet. This is what companies release all the time. They're always comparing from prior months, prior years. So you might take a look here. Let's see here. Well, they grew their assets. That might be good. And you look at the bottom, the equity went up. So, okay. They have less cash now, but it looks like they made good use of it. That's the type of thing you'd be doing, okay? International. Don't care, my friend. Here, even though you're going to do your ratios and that type of analysis in the FSAs, which is why we're skipping that one chapter late in the course. We're going to do it throughout the course. Very key item here. Super, first thing I bet investors look at, what's called the current ratio. You divide current assets by the current liabilities. In this case, you divide the 501 by the 157, and you come up with 3.18. That's a ratio, huh? What it means, though, is that Chipotle has $3.18 available to pay down every dollar of its current debt, should it choose to do that. So 3.182, I would think that's a pretty healthy ratio, huh? Another way to say it is, if they paid down the entire 157,500, they'd still have $2.18 left over for every dollar they just paid down. So the current ratio is a real key metric, a very simple one. Everybody looks at this. And they're giving you a little note down here. The current ratio for Chipotle was a high level of liquidity, above 1, and the ratio has been around 3, and they have high growth, etc. If this ratio was reversed, it would mean you did not have enough to pay off your current debt. That means technically you're insolvent, meaning you don't have enough money to pay. You're not out of business necessarily. You could be driven it that way deliberately because you know that things are going to be good pretty soon. But we like to see this number above 1. If the number was 4.81, would that be better or worse, Nicole?
Better.
Yeah. What about 6.18? Better or worse?
Better.
Ready for the trick question? What if it was something like 30 to 1? Would that be better?
Yeah.
Well, it would be better, except
It's really good.
You could argue that they're not using their assets to the full extent that they should be. So you can actually argue that it's not a good thing, I would think.
Bingo. You got that, Nicole? If you're hoarding cash like that, if you have a 30 to 1 current ratio, if I was a shareholder and I was not getting a dividend, I'd be pretty mad. I'd say, what are you doing with all that money? Why are you hoarding it? You know, you had an opportunity to buy Apple stock when it was $2 a share. Now it's going up near 2,000. You get the idea, right?
Yeah.
You want to manage it to a reasonable level. 3.182 is pretty good.
Okay.
Key ratio. Again, cash flows, we only need to know 3 things for this part of the course, and we just went over those in a little bit of easy detail. Operating core expenses, the cost of goods sold, what you paid for the product you sold, advertising, marketing, you got to pay the accounting department, human resources, you got to buy supplies, you got to pay people. Investing, 2 things really. You purchase an asset or you loan money. And of course, you can hopefully sell them for a profit and collect principal payments and interest. Financing is borrowing or issuing stock. That's all we're talking about. Those cash flows. End of chapter 2. All right. Let's get rid of that. Now, hold on here. Okay. Again, this is this set of slides here, slightly different from the ones we saw the other day. Same publisher, same type of information. Okay. We're going to stick with Chipotle's. We went from Papa John's to Chipotle's. Chapter 3. The operating cycle. The operating cycle. What they're talking about is the cash-to-cash cycle. I guess we're going to start it over here, huh? We get cash from customers, and then we use it to pay people and buy things, and then we pay those people, and then we sell. The cycle. The operating cycle. In baseball, the cycle is you hit a single, double, triple home run the same game. Don't forget that. That's the better cycle. The operating cycle, the time period over which we're reporting. The time period. In your book, we're always talking about, oh, we're going to now do the financial statements for the whole year. No, companies do them once a month, obviously. You can do them quarterly. You can do them daily if you want. Recognition, again, when should operating activities be recorded? We know it's when they're incurred, and what amounts should be recognized, huh? On the income statement. Well, we know right now that the income statement is revenues minus expenses, on sales minus expenses. That equals what is called operating profit. That would be one of the first things investors look at probably after the current ratio. Okay, they have a good current ratio. Let's see if they're making money. And you see revenues minus expenses. That equals operating profit. Means the money that Coca-Cola generated by selling this stuff. After operating income, there are other minuses and pluses, gains and losses. And we can call these expenses too, and revenues, but the proper term is gains or losses. These are things like interest income. If we loaned money to somebody, this could be interest expense if we borrowed money and there was some expense involved. If we shut down a division, we discontinued an operation. Those types of things have nothing to do with the core business of generating soda. So they go after operating income, and when they're subtracted, now you come up with net income, okay? And let me make this a little bit bigger. Here we go. Take a look at this now. Here's what we're talking about. Chipotle, that's really $2 billion worth of pizzas, huh? They sold. Here, you see the food, beverage, and packaging, Dominic?
Mm-hmm.
That is your cost of goods sold. That's okay. When you bought a pizza, that pizza had pepperoni and cheese and onions and all kinds of stuff, right?
Mm-hmm.
And maybe you had a soda, and they had to put it in a box. That is the cost of goods sold. And we're going to get into that quite a lot as we go along here. So now these expenses are laid out. Salaries, rent, occupancy, other operating, general. Operating expenses. Sales minus operating expenses gives you your operating income. Income from operations. This is what investors would first look at. And so would the employees, because many of these people, of course, have bonuses and expectations and goals they're supposed to meet, and that is all part of the operating. Operating represents the part of the business that's under control of management and the supervisors and other people. Here, income from operation, investment income. Well, it's nice that they earn $2,100,000, but that has nothing to do with making pizzas. It looks like they borrowed a ton of money, or perhaps, issued stock, whatever. And here, they got rid of a fixed asset, although that rule has changed and that's now operating. But I hope you get the general idea here. Income from operations. This is the one where you can beat up the employees. Why was the food $738,000? Our budget said it should have only been $700. You can go to the purchasing people. You can go to people making and have a confrontation. I don't say confrontation, but a discussion. Salaries and wages. These are things controlled by the managers. This is not. So you have pre-tax income minus net income. Earnings per share. Earnings per share. Here's another metric, another important metric. Earnings per share, $6.89, huh? What was their bottom line after tax income? $215,000, right? My bad, let me fix that. Got happy fingers. The net income was 215 million on 31 million shares. You divide that out and you get $6.89 per share. That means that Chipotle generated that amount per share, which represents monies that they might want to pay out in a dividend. They might want to hang on to it. They might want to invest it in another company. They might want to buy a new building or something. You get the idea. Earnings per share, $6.89. I'm not sure that's good or bad. I would think it's pretty darn good, huh? Earnings per share. Operating expenses. Any outflow of cash for any purchases, any purpose, whether to buy equipment, pay off a bank loan. I don't like that, to buy equipment. That's not right. Expenses or outflow. Here we go. So what are the typical operating expenses for Chipotle? Well, they got to buy pepperoni and cheese and flour and salt and yeast and all kinds of things and herbs and seasonings. They got to pay the people to make the pizza. They have to occupy buildings. They have to rent buildings, or if they own them, they have to pay property taxes. And there's all kinds of other operating and general administrative expenses. Depreciation. Here we go. How are what cash basis? I'm going to avoid cash basis like the plague. We've talked about that. We're not teaching the cash basis. Nobody uses cash basis accounting if they want to borrow money, if they want people to believe their statements. And I believe if you use cash basis accounting, you'll cash basis yourself out of business pretty quickly, okay? It's only useful for real tiny places, I think. Accrual accounting, here's what we're talking about. Assets and everything recognized when the transaction that causes them occurs. Has nothing necessarily to do with when the payment. Required by generally acceptable accounting principles, GAAP. And we'll go over this again, maybe a little more quickly than we did Monday. These will be slightly different transactions, huh? When we deliver the product, when we provide the service, when that truck leaves our warehouse with the goods on it on its way to a customer, that's when we record the revenue. Revenue is recorded when the service or product is provided. When we get paid is irrelevant. We might get paid before, we might get paid afterwards, or maybe it was a cash deal. So let's take a look here. When cash is received on the date it's earned, that's pretty easy. We debit cash. We debit cash and credit revenue. Revenue and cash at the same time. They're reminding us. The revenue principles. What if we were paid? What if Chipotle got paid in advance? What if we held a big party? We had our class decided to have a big party on campus, and we sent Chipotle's $1,000 and said, bring us 100 pizzas on this particular day. That to them is unearned revenue. They receive the cash, but they can't record the revenue yet, not the actual revenue. They have to record unearned revenue, which is a liability account. When they deliver the goods, you record the revenue, and when you get paid, you relieve the liability down here with the debit to unearned revenue and a credit to revenue or sales. Cash first, revenue later. This is a very typical item here. This is how most of the world works, huh? On credit. Cash is received afterwards. Cash is received afterwards. That's your basic debit accounts receivable. Credit, sales, or revenue at the point of delivery. As soon as that truck left your factory or whatever, whammo, you received the cash, you debit the cash, credit the accounts receivable. That's how most of the world works. Same thing with the expenses. The expense is recorded when it's incurred. Incurred. We all like that word, incurred. When it happens. When it happens. We used electricity during the month. The month has ended. Well, we're not going to pay for that electricity for a while, but we sure as heck have to recognize that we used it or incurred it. So what do we have going here? Cash is paid on the date. In this particular example here, assuming we're still Chipotle's, you walked in Chipotle's and you had lunch for $12, and your expense was that $12, and you paid cash. Okay? Or somebody came in, they fixed the copy machine. Guy fixed the copy machine for $100. You debit expense, you credit cash. Cash transaction. Let's take a look here. When the expense is incurred, prepaid expense is, okay. Cash, here they're talking about the prepaid expense. Here, we paid in advance for a service that we're not going to get until the future. So we debit the asset called prepaid expense, we credit cash. And again, I'll go to my favorite. This is an insurance policy that begins the following month. Well, when the next month is done, we have to take 1/12 of this number probably and credit the actual expense, insurance expense, and credit the prepaid asset. And at the end of 12 months, assuming it's a one-year policy, the prepaid asset will be zero, and we've recorded $12,000 worth of expenses in monthly increments. And here is the reciprocal to accounts receivable. The deal is, you sell me your product and I'll pay you 30 days later. That's our deal. This is normal business. We debit the expense. Thank you for selling me that stationery. We debit stationery expense, credit accounts payable, and then when we pay, credit the cash, debit the payables. This is real basic stuff, but it's good to review. And now they're dropping down our accounting equation. Now they're adding this portion down here, revenues and expenses afterwards. And I have to do something here real quick. Let me just move this out of my way. Get out of the way. Okay. Retained earnings increased by a credit. Expenses increased with a debit. Revenues have credit balances. Expenses have debit balances. The difference between the revenue and the expense is the profit, And that profit is going to end up going, hopefully, on the credit side of retained earnings because you made money. I know we're good with the debits and credits. Okay, let's see what they're showing us here. Okay. Remember they said finish those transactions yourself? I guess now we're doing it. What are you laughing at, Nicole? You find this funny? No. Okay. Chipotle purchased food and supplies for that amount and paid so much in cash. So they debited supplies, which we know is an asset. They credited the cash, the difference. They had to finance. They're going to pay later, accounts payable. And they're just showing you the assets growing here. Assets went up with the supplies, but the cash went down. And the difference is accounts payable. Here we go. We paid $36,000 in advance for 6 months of, can't read that. My screen. Oh, rent. For 6 months of rent, $32,000 for insurance coverage and $18,000 for advertising. All of these are prepaid expenses. You debit prepaid expenses and you credit cash. Assets did not change at all. Total assets remain the same. You just switched assets. You would rather have the prepaid stuff now and gave up the cash for that. Wow. We sold food to customers for $619,300. 4,000 was sold to universities on account. And you know, whenever you see on account, that's because on account and nobody had money and the cash was received in stores. So here we go. They're telling you that they sold food totaling $619,300. This is what went through their cash register. $619,300. That amount. Of that amount, $615,300 came in the form of cash or credit cards, and they gave a little bit of credit to people. You can pay me later. You good with that, Nicole? Okay.
Yeah, I think I got it.
Management training expenses. Paid. As soon as you see the word paid, you know it's a cash item. So assets, cash goes down, and expenses go up, but equity goes down. The point on that one is to show you the asset goes down, so does equity. They paid employees who worked this quarter for 138.6, and last quarter for 91.5. So here's a good one. Let's look at this now. Here we're getting into our perhaps an adjusting journal entry, huh? They paid employees who worked this quarter for 138.6 and last quarter for 91.5. Last quarter for 91.5. So what do we have going here? Our expense is, I'm sorry, 138,600, okay? This is the expense for this month. How much did they have last quarter? 91.5. That we have to pay now. So we have to pay a total of 138 and 91. Credit cash. Record this expense, which we have not recorded, and pay this expense, which we accrued last month. Any questions? I think this silence is telling me you're a little foggy on this one, right? Okay, what happened here? Last month, at the last quarter of last month, the last week of the month, employees worked, right? They worked from the 25th to the 31st of the month, last month. And that month, we debited salaries expense and we credited salaries payable. Make sense? That money, that 91,500 was earned last month. So we had to record it in the prior month, which we did. And they're showing you here, it's 93.1, probably supposed to be 91.5, but that's okay. That is how much they had accrued there. Oh, they're showing all expenses, so that's fine. Of this 93.1, 91.5 is being paid now. But while we're paying that 91.5, we're also paying the first 3 weeks here, the current month. And that's where you get the 230,100. When you start doing your adjusting journal entries, you will see that this is a pretty common item. This is called an accrual entry. I don't want to overload you guys right now. Oh, here they sold land for cash. They sold it. It cost them $11,900 and they lost $1,300. Oh my goodness, this is not good. So they received cash of $11,900, but they had a loss. What do you think, Dominic? The property and equipment was $11,900, right?
Yeah.
We sold it.
For
how much did we sell it for?
Cash.
Pardon me?
Oh, 10,600.
Yeah. We had a piece of property on our books, 11.9. We sold it for 10.6. That's a loss, right?
Yeah.
Gain or loss on the disposal of a fixed asset. You'll be doing a lot of those journal entries in a couple of chapters. Gain or loss on the sale of a fixed asset. We had a car, perhaps, that had a net book value of almost $12,000. And it was time to get rid of it, but we could only get 10.6 and suffered that $1,300 loss. The key point is that loss will reduce your stockholders' equity. Hey, people paid us. Wow, well, that's a tough one, huh? We debit cash, credit accounts receivable. Has no impact on equity. And now we pay people on account. This means that we're now paying items for things we bought in the past. Here, we're crediting cash, and now we're debiting accounts payable. On account, we're paying them on account. It means they gave us credit. Ooh, we got more expenses, utilities and maintenance, huh? So they're breaking them out into two different categories, I guess. 10,000 for utilities and 48.6 for training. Cash, again, reduces equity. Now we earn some investment income, huh? Yeah, you know, those shares we bought in McDonald's paid off. They're paying us a little bit of a dividend now. So we debit cash and we credit investment income. And of course, whenever there's income, your equity goes up. And we're getting toward the end of these. Okay, so here's a good one. Chipotle sold gift cards to customers for $15,400. Well, we should be pretty comfortable with the journal entry. We're going to debit cash, and we're going to credit this liability account called unearned revenue. Again, no impact on stockholders' equity until people start using these gift cards. So here we go. We've prepared all these journal entries and we posted. And here are our balances: 370, 94, 9100. Here are the income statement items. Our revenues are now 1,619 plus that. Right now, we can come up with a preliminary income statement in 30 seconds. This plus this are your revenues, and these are all your expenses. So we're going to fill out the trial balance, and we're going to get all the numbers from that set of T accounts we just looked at. Okay? Cash. This is unadjusted. Unadjusted. So at this point, I think we're assuming that the trial balance is good. When we think the trial balance is finally adjusted, we can prepare a statement. You have to do the income statement first. We know that because the net income is going to be added to your equity. Income statement, revenues minus expenses. Equity statement, beginning equity plus net income minus dividends equals ending. You got to bide your time with the stockholders. Bide your time, B-I-D-E. Beginning plus income minus dividends, huh? And here they're giving you the flow. Net income flows to the equity statement. And when you get the ending equity, you're going to bring that over. Yeah, they're just making the caveat that I was trying to make a moment ago. It's based on unadjusted balances, so we're not worried about adjusting. We're just assuming it's good. Okay, so here is your income statement: 609, 376, income before taxes, etc. Income statement. So that net income number there. What could you read me the net income number on the bottom, Dominic? It's blocked on my machine. Can you see that?
376,200 or billion.
After
right?
after income expense.
After.
See what it says net income on the bottom?
Yeah, that's what it says. Because
376.
income tax expense is 0.
I didn't know that.
Okay,
Okay, thank you. Okay.
Yeah.
Hey, we're up to another good metric. These are all the basic stuff, huh? The basic stuff. Here we go. Our net profit for 2011 was this number. They're using this number here. See, that's quarter 12, right? It annoys me when they throw different numbers into the next one. So for a different time period, they had a net income of 215, right? They're telling us that. You divide your net income by your sales. Obviously, you're going to come up with a percentage. 0.0947, you move the decimal over, 9.47%. In 2011, Chipotle earned a net income margin of 9.5%. We'll call it 9.5%. Is that good or bad, you think? The answer is pretty fluent. It depends on the business, what the expectations are, what's been going on in the market. Right now, Chipotle collecting 9.47%. If they took that money, you see that 2,269,500. If they put that in a bank today, they would have barely gotten 1%. They would have only gotten 22,000. They would have only gotten like 1, 2. I can't even do it. Such a small number. The point is, they would not have gotten anywhere near this. A better and hopefully clearer way to say it is this: for every dollar of sales, Chipotle generated almost a dime. They got 9.5% on their money. If they had invested it, if they had invested this money, they would have gotten way below 1%. Okay? Net income divided by sales, very basic metric. But you can see how important that is, huh? See, right now with interest rates so terribly low, and they're going to be low for a long time, according to the Federal Reserve Chairman, Jerome Powell, people need to find ways to make some money. And you're just not going to, old guys like me, 20 years when my father retired, 40 years ago, he could earn 15, 16, 17% of it on his money in a basic certificate of deposit. Those days are long gone. So, okay. And I guess that's the end. So I think that's a pretty good workup on Monday for those of you who want to look at that. This was kind of a supplement to that. And I guess we're ready to hit the bricks. Any questions, Dominic? Any other things I can do for you?
I don't think so.
Okay, so you feel pretty comfortable with the Chapter 3 homework then, huh?
Yeah, and that Excel spreadsheet looks a lot easier now. I don't know why it was so hard at the beginning.
Yeah, I didn't realize that Cornelia was asking you to do it in Excel, but that's good. Do you know how to use Excel?
Oh, yeah.
Oh, for heaven's sake, that says you knocked this one right out of the park, huh? Sounds good. How about you, Nicole? You're an expert. I bet you are too, right?
Yeah, I actually, where I used to work, I use QuickBooks a lot.
Oh, for heaven's sake. Well, you know what you have to do? What is your major, Nicole, if I may ask?
Finance.
Hey, you probably will love to take Professor Carolyn Terry's QuickBook class.
Oh, yeah?
That she loves to teach. And
okay.
she's always got a big classroom and everybody loves Carolyn.
Yeah, okay. And what is her name? What?
Carolyn Terry.
Carolyn Terry. Okay.
You know what you might do if you wish, you could pop her a quick email and say that I recommended you and see what her reaction is.
Okay.
Hey, Dominic.
Hey.
You said you're a bit of a baseball fan?
Oh, yeah, I love baseball.
You're familiar with the good hitter from the Mets, Jeff McNeil?
I've heard of him, yeah.
Yeah, he's one of the best hitters in baseball. That's Carol and Terry's next door neighbor. Just remember that.
Really?
Used to be for many years. Okay, with that in mind, I'll let you all go. Okay, you have a good rest of the weekend, and we'll hook up on Monday, not Monday, Wednesday at 10. Okay.
Alrighty. Thank you.
Thank you.
Hey, bye-bye.
Bye.